Welcome in. This is the Tuesday Not So Deep Dive episode. We have Brad Freeman on the show coming in every other week with this one. And we are going to be talking about Dutch Bros. I think it was because of the ticker for some certain investors out there kind of liked that ticker name, but it's been one of the hottest IPOs. So we wanted to check it out. We read through the S1 and we're going to talk about it today. Brad, have you ever heard of Dutch Bros? Because I know you're on the East, towards the East Coast. They're not really out there.
Yeah, I've never heard of the brand up until its IPO, believe it or not. So this is brand new to me.
No, I've never been, but Ryan has been, and he can say there is kind of a cult following.
We'll save it for anecdotal evidence.
We'll save it for anecdotal evidence for sure, but it is very interesting, and it's going to be a nice little fun one here. But let's talk about potential multi-baggers first, our flagship sponsor. The aim of potential multi-baggers is to find stocks that can go up 10x over the next 10 years or compound at 26% per year. So a high bar there. And they've actually outdone that since the beginning. And it's not just for a year or something. It's been quite a few years. We're probably coming up on year 5 or something like that. There's tons of different things you get with it. Chris, the head of potential multi-baggers, has another team of analysts with him. I'm not sure how many there are, but there are a few that are helping them out with the service. There are also several portfolios different for different styles and stuff like that. Each month, Chris shows you what he would add to build a portfolio over time. So there's helping, teaching you how to, do some portfolio management, all that stuff. All portfolios can be tracked in real time, which is also great. There's tons of transparency here. Any of the 2-week free trial, Ryan?
Also, he has a really interesting background as to when he started potential multi-baggers, kind of his transition away from teaching. If you ever want to listen to that, you have to dig through all of our old episodes and you can find it, but it's pretty interesting.
Yeah, definitely. And he is, he does love talking with people. So if you're part of the service, you'll be able to talk with him personally and ask all those questions too. Accountability is important to him. And with the live portfolios, you can see how every pick is doing in real time. So if you want to become a multi, you can go to Seeking Alpha and look for From Growth to Value, Google it, or go to @FromValue on Twitter. Ryan, I'm going to let you introduce Dutch Bros and give a quick hit on 7 Investing, because that'll be coming out right when you're listening to this.
Yeah, so we are recording this on Thursday before this drops. And so tomorrow, the 7 Investing Recs will come out. That's the first of the month, I believe. So we're kind of eager to see those. It's always good lead gen. So remember, you can use our code CCM. That's enough of the sponsorship. So let's get to the show. So we are talking Dutch Bros today, and I am a customer, so I'll kind of go through what they do. So the first line there is one. There's a few words that are all caps, so just ignore those. But it says Dutch Bros is a high-growth operator and franchisor of drive-through shops that focus on serving high-quality, all caps, handcrafted beverage with unparalleled speed, all caps, and superior service, all caps. So
they're passionate. I don't think you
can tell.
They're very passionate. Yes.
It's pretty much a chain of drive-through coffee stands, but they also generate a lot of sales from their Blue Rebel brand, which is basically just a flavored energy drink. It's a lot, I guess, like a Red Bull soda. I think that's maybe why they call it Rebel, because it's basically tied to that. Kind of the names are similar and it tastes like a similar drink. But if the reason I bring that up is because that is the leading product in the afternoon. So that drives a lot of traffic throughout the day past the morning. And then more operationally, Dutch Bros has 471 stores across 11 states. It's pretty much all West Coast. Sorry, Brad, you haven't got to experience this.
Maybe in a few years. Rapid expansion, they said, is coming. So they're going to hit Michigan eventually.
Right now it's Washington, Oregon, which is where they started, California, Idaho, Nevada, Arizona, Colorado. And then over the last year, they moved into New Mexico, Utah, Texas, and Oklahoma. And about 56% of their stores right now are franchised, and the remaining 44% are company operated. But the company operated store count has gone from 37 at the beginning of 2018 to 182 at the end of 2020. So they're really focused on having most of the stores be company operated, kind of long term. And they target 25,000 square foot lots for the whole premises. Except the actual shop is less than 1,000 feet. So it's mostly just drive-through lanes. There's like a little patio as well. But if you've ever driven past one, they basically just have like three, 4, 5 different drive-through lanes that converge into one and usually it's kind of congested. There's a lot of traffic because people are trying to get through. Sometimes the shops will have 2 lanes. It's a lot like a traditional coffee stand, just with more traffic essentially. And then they also they have escape lanes. They made sure to point that out. So if you ever need to get out, you ever want to abandon ship halfway through your order, you can just hop out. 90% of their product sales are from drinks. They have funny names for all their drinks. So some of the examples I found were Iced Tiger's Blood Lemonade, Golden Eagle Freeze, which I think is just like a caramel frappuccino, and then Electric Berry Rebel. So it's stuff like that. It sounds weird, but their cult-like following that they've cultivated loves it. And it's like a barrier to learning the nomenclature is like a barrier to entry. And it's
as a consumer,
yeah, like once you're in, you feel like a part of an exclusive group. It's weird. I know the rational consumer that Brett is doesn't really understand it.
Congratulations on being in that exclusive group.
A little bit history about the company. So the company was originally founded by, you guessed it, 2 brothers with Dutch descendants, I think.
They better be, yeah, or else they're lying to us.
Yeah, and so their names are Travis and Dane Boersma. I might be butchering that last name, but Dane has since passed, but Travis is still the executive chairman, which Brad will talk more about. And it was actually started in 1992. So this is all mentioned. And Travis writes like an opening letter in the S1. It's worth a read. And they were both 3rd generation dairy farmers that I believe grew up in Grants Pass, Oregon. I know that's at least where the company started, but basically they started out by purchasing an espresso machine, selling out of their barn. And they also had a stereo to go along with it, which they ended up doing pretty well. So they eventually bought a push cart. They moved to downtown Grants Pass, Oregon, where they kept that same model. And basically the stereo and an espresso machine started to do pretty well. They made about $100 a day from that. They started to train some people. They had 5 of those. And then eventually they moved to a drive-thru with a patio. So this is it's like the lemonade stand gone corporate, if you will. It's kind of like the ideal, I guess, small business growth story. And so later someone asked, I think it was one of their recurring customers, they said they wanted to try to do the same thing in a nearby town. And he said he would pay to use the Dutch Bros name. That was basically the inception of their franchising model. And then 30 years have passed, so they've obviously grown. But in 2008, they stopped allowing new franchisees to open stores. I believe this slowed growth. And instead, they said only people that are part of the Dutch Bros system were allowed to open new stores. So I think the goal of this was to help maintain the culture and keep the experience the same. They say this in their S1, but they said every time you come to a Dutch Bros, we want to feel like a celebration. And so the culture is a big part of the experience for the customers. I think they wanted to preserve that. And so that's why they've tried to keep it all within the Dutch Bros system. So existing franchisees can open new stores, and then employees can obviously open new stores as well. But they have to go through this leadership pathway program, which I'll talk a little bit more about later. I think that gives a little background and context for the business.
Great overview. I'll hit industry competition. Pretty simple, but honestly, it's a little tough to identify because they're really selling something different than Starbucks. You can identify Starbucks as like a competitor, but I almost say it's like a half competitor because they're not targeting just like the monotonous, morning drink, stuff like that. As Ryan described, it's trying to be more of a special experience, for lack of a better word. But the restaurant industry as a whole is about $600 to $800 billion estimated in the US. Could be as high as $1 trillion. I know the numbers kind of just range around there. I don't know how helpful that is, but that's just kind of, if they ever expand into food or something like that, there's no market saturation that they're going to hit anytime soon. Dutch Bros, though, is going after drinks and coffee. Coffee is estimated to be about 5 billion sales in the US. That could have been a number. Starbucks could be higher than that. So that could have been just like at home or only in store. But just know that coffee's not like the dollar sales aren't going to be that high. I think I may have gotten a smaller number there. That could have just been a subset of the coffee market. And then drinks overall, though, are going to be definitely higher. Like Ryan mentioned, they're not just selling coffee. And I think 82% of their drinks are sold cold. So a lot of them, a lot of the customers are just going for these mixed drinks, and the Blue Rebel, people kind of know about that. That's the classic one. That is their huge, what would be a comparison, Ryan, to something that is popular? Kind of like Taco Bell has that one, right? What's it called? It's kind of like that. Like, that's their number one drink. That's Dutch Bros.
The Blue Rebel is just the energy base, and then it's like derivative drinks off that, so you can like add flavors and stuff like that. That's basically just the core of it is the energy drink Blue Rebel.
All right, and then for reference again, if you're wondering about their store count potential, Starbucks has 15,000 stores in the United States alone. I don't think Dutch Bros has the potential to get that high, but just know that for coffee and these little shops, I mean, there's plenty of room to go into multiple towns and stuff like that. And then from a competitor standpoint, I'd probably identify the, individual coffee stands, and well, there's also bikini baristas too, which, people laugh about, but they're very popular and there's a ton of them. Those are definitely their main competitors, just those little stands that are similar to Dutch Bros, but just people have on their own, or little small chains in local areas. Starbucks is probably less of a competitor, although you're really competing, I think, for someone's quote, like specialty drink that a lot of people have. They may have once a day or once every few days. It could be an energy drink, soda, something like that. You're really competing for that time. Brad, do you want to hit management and ownership? Ryan, you have one thing.
I'll add something just before. I think your coffee number might be a little bit off.
Yeah, I could have written down wrong.
Starbucks has 27 billion in annual revenue. Now, not all that comes from coffee, and they obviously have a lot of.
And not all that is international, but yeah.
But I
think it's higher
than 5 billion.
I think I must have gotten a subset of either at home or restaurant only. But yeah, that's probably a little low. Brad, carry on management and ownership.
Sure. So Travis Boersma, we got a pretty good overview of him. If you're interested in getting an idea of his personality, just go to his LinkedIn profile and look at his picture. A picture here is worth more than 1,000 words, but he does have the cleanest LinkedIn experience page I think I've ever seen. It's just co-founder and president of Dutch Bros, and that has been his professional career. So good for him figuring out something he's passionate about and making it work. But moving on to the current executive team, the CEO is Joth Ritchie. So he's been with the company just since January 2019. He also currently serves as the Racial Justice Council for Oregon's governor, and on the board of directors for the Oregon Business Council. Boersma, that family is also very much so based in Oregon. So very strong ties to that state. He's also been the president of Stumptown Coffee Roasters, where he delivered a lot of profitable growth. He got it to 64 million in revenue before he left, so it wasn't tiny. Pretty good success there. Former CEO of Jones Soda. I used to drink a lot of Jones Soda, so that put a smile on my face.
Yeah. It's a good drink.
Absolutely love it.
It's a good drink. Similar. It actually makes sense. That they went after.
Yeah. Yeah, it makes perfect sense. And just 32 ratings on Glassdoor. So very, very little grain of salt here, but 90% rating for those very limited reviews. But the CFO is Charles Gemley. Pretty impressive resume here. He's been with the company since January of 2020. He was with Starbucks for 12 years, from 2006 to 2018, climbed from vice president of China to the senior vice president of finance, global digital, and store development. So 3 very important things. He was also the former CFO of Yum China from 2003, 2006. So the resume here is really, it's pristine. The COO is Brian Maxwell. He's actually been with the company since 1992, where he began as a broista manager. And I can't say broista with a straight face. Broista.
We'll have to talk about, I have that in anecdotal evidence. I'll have to ask about that.
Okay, so the quote was, for his experience as broista manager and mind blower. So he definitely took a lot of pride in his job making people delicious drinks, but he climbed the ladder for 3 decades and he's now the COO. So really interesting and compelling contrast between a CEO and a CFO with really relevant, impressive experience, and then an operator who's been here for 30 years and knows the culture, I'm sure, as well as the Boersmas. But from an ownership structure, the word to describe it is bananas. There are 4 different classes of stock. So one of their core investors, TSG Community Partners, owns 100% of the Class C stock, 33% of the Class A stock, and 22% of the combined voting power overall. That's after the offering. The Boersma family owns all of the Class B stock and 44.1% of the Class A stock for 74% of the combined voting power. Ritchie and Gemley own just 3.3% of Class A and virtually 0 voting power. And Brian Maxwell, the guy who I just talked about being with the company for 3 decades, climbing the ladder, he is not listed as a shareholder on the S1, which I was a little bummed out about. I mean, he climbed the ladder for 3 decades. Give him a nice fat equity package to say thank you for being with us for 30 years and climbing all the way up the ladder. But I digress. That's the crazy ownership structure.
Yeah, no, that's a good overview. And I got to say, a guy named Joth Ritchie fits in perfectly with the kind of culture that they have there. That his name seems on point to me. But I'll hit valuation. Market cap is about $7.3 billion. You should remember that this is a recent IPO. There was a lot of hype around it, and the stock's traded almost like a meme stock where it's been up or down like 10% of the day. So make sure to recheck these numbers. I'm going on a market cap of $7.3 billion. Ticker is BROS. So just bros. Perfect ticker. I love it. Honestly, I can't believe that no one had taken that one before. Trailing 12-month price to sales of 18, trailing 12-month price to gross profit of 52.5. I think this is an important point here. Ryan will get into it more in the earnings, I bet, but the gross margins are not, as you expect with a restaurant, it's not software. They're going to be a bit lower. Trailing 12-month price to operating cash flow is 82. It's not bad. However, I don't think that, now this could just be an assumption on my part, but I don't think that conversion is sustainable. I forget, I didn't write down specifically why, but whenever I looked at the statement, I saw some things that I was like, all right, is that going to continue every year? I don't know, but it might. Then they have a lot of SBC as well.
I'd say that they had, I believe, around 60 million in operating cash flow in 2019, and then 55 million in operating cash flow in 2020. So I think it's around 20% cash flow margins, but why don't you hit your last point and then I'll talk more about
it. And I see that versus 29% contribution margin. I think, is that sustainable? I don't know. Brad, you have something?
Could those cash flow margins be related to, well, I guess that's operating cash flow. So never mind. I was thinking about CapEx from all this expansion that they're doing, but that would not impact operating cash flow at all. So never mind.
I think a lot of it is SBC. So however you'd like to treat that.
I think that might be wrong.
All right. Well, the last thing we have is, and I saw this in the S1, they have 17 million shares that may be granted under the 2021 equity incentive plan. Shares outstanding are 165 million. So it's not like crazy, but I would expect dilution going forward. That's something you should probably price in here. Ryan, do you want to hit earnings?
Yeah. So I'll go through it. Sorry, I'm trying to figure out. I think you might be wrong on the SBC number, but they had $404 million in trailing 12-month revenue. And then from 2019 to 2020, revenue grew at about 37% year over year. They released this after, I think, the second quarter financially. So there's I'll have some of the 2020 numbers to give sort of a more annual look at it. But in 2020, they had same shop sales growth of 2%. The reason I put that down is this is a year when traffic largely dropped because of COVID. And they mentioned the difficulty that COVID brought. For reference, even though Starbucks isn't the same model, I think their comp store sales dropped by 15%. They've had 14 consecutive years of same shop sales. So I think that gives you same shop sales growth. I think that gives you an idea of how much the customers like it. And then 2019 to 2020, they grew store count by 19%. The company stated that its 2020 contribution margin was 29%. So that's basically just the profitability on a per shop basis. So that's excluding corporate expenses. And then last 12-month adjusted EBITDA margin was 20%. I guess take that with what you will. And then in 2019, Dutch Bros had operating cash flow margins of 24%. Keep in mind, GAAP free cash flow accounting is actually pretty useful for a business like this. So if you traditionally just look at free cash flow as operating cash flow.
You said GAAP free cash flow, or is that what you meant?
Traditional accounting for free cash flow. So operating cash flow minus purchases of property and equipment, because that's them expanding to new stores. So that's kind of their CapEx or their growth CapEx, if you will. And so free cash flow margin for 2019 was only 7%. So over time, as new store expansion starts to become smaller, which I think it will have to if your store base gets large enough, they should see a little bit better cash flow conversion. There will probably, I imagine there's some maintenance CapEx on like keeping the stores up to date, keeping the coffee roasters.
There's got to be,
kind of depreciating those or finding new ones. So there's probably some, I don't think free cash flow margin will ever be equivalent to operating cash flow margin, but it's not, I mean, free cash flow margin right now, I think we'll get much closer to that 20% number over time.
It should. And that's probably a debate you got to have as an investor. And then you had the question on cash flow, Ryan. So in 2020, they had 53 million in operating cash flow and they had 35 million in SBC. But in 2019, it was a lot less. So they had 56 million in operating cash flow, very similar, but only 6.7 million in SBC. I don't know what number to trust going forward, but there's going to be some. It might be as high as it was in 2020. That might have been a one-time thing. Who knows? Balance sheet, though. Let's wrap up the first half. Brad, what do you have for that?
Sure. Before that, a quick question for Ryan, because he's been to the store. Is there in-house dining there, or is it just only drive-thru?
There's like a patio that you can kind of sit at and order.
Okay.
Ian,
is it fair? Sorry, go ahead.
Ian said he used to go there all the time. I don't know. I guess we could ask him. I was just going to, actually, I didn't realize I have a few more numbers just to cite. 91% of their shops open more than, that have been open for more than 15 months, generate shop level contribution margin above 20%. Thought that figure was kind of interesting. And then within the first 2 months of launching a mobile app, Dutch Bros had 1.6 million member activations. And they launched this during COVID. So that's kind of to give you an idea of, and that is, I'll talk about that, but it's much higher on a per store basis than a company like Starbucks, who also has a cult-like following, but they now have 2.3 million active members. But I'll let Brad kind of hit the balance sheet.
Yeah, just I asked about the in-store option just because kind of trying to gauge how big of an impact COVID-19 had on their operations. Maybe it even could have been seen as a relative.
Honestly, I honestly think it was a benefit. Yeah.
Yeah, because I mean, you're not going into Starbucks to get coffee, but that's maybe a little more palatable for people who are nervous.
They give a chart of COVID's impact, and COVID certainly did not help the business.
Yeah, it was like 2 months it was down, but then it was back up, right?
Yeah, and I mean, there was just less commuting, which I imagine this is
that can negative. Yeah, that's true. That can negatively impact it. Yeah.
Good point. Definitely competing factors. But moving on to balance sheet and liquidity. So we talked about this at length before the show, but the company's all of the sources you're going to find will say that the company raised nearly $500 million in cash, but a lot of this cash, as Brett told me, was used to kind of clean up some credit facilities that they had outstanding, and also to buy back some of the stock from these 4 classes of shares that they had, just to kind of clean up the balance sheet a little bit. So it looks like, and we're not 100% positive, but it looks like, according to their pro forma cash position, that it's only around 50 million, despite the $500 million raise after the IPO. Now that's not the end of the world, considering they are profitable. But it is definitely something to keep in mind. They do also have still 24 million in outstanding credit revolvers. They've got another 191.7 million in long-term debt outstanding that's going to mature over the next 5 years. That's got a 5% interest rate on it. But again, net income positive. So liquidity isn't ideal, but it's manageable.
Yeah, I think if you're interested in Dutch Bros, you definitely, the balance sheet for the first 10Q will be very interesting, because I want to see how everything shook out, because they're giving you the numbers. You can kind of add it up, but, and there's also the one thing we don't know, if there was that option for the underwriter option to purchase more shares. So they could have raised more than what they originally had on the S1. So the cash balance might be slightly higher. Again, Brad had a tough task this week with the balance sheet and ownership. It was a bit confusing, but hopefully we cleared it up a bit and simplified it.
I think a proxy and a 10Q, a proxy statement and a 10Q would be very helpful.
It will be helpful. And that's why IPOs, that's a big reason why people like us, we like to wait sometimes. Brad?
Yeah. Also, if we could institute a rule going forward, only 2 classes of shares per IPO, that would be greatly appreciated.
Yeah, I'm going to run for Congress, and that's going to be my whole whatever platform. No adjusted EBITDA, and no only 2 classes of share structure max. All right. Yeah. Let's hit the ad break, and we'll get back and have more analysis on Dutch Bros. Okay, welcome back. We have anecdotal evidence now. Ryan can probably talk more to the experience. Unfortunately, I haven't been to one, but Brad, what are your thoughts on this? I know you haven't been to one, but what are your thoughts on the concept? This is the question I have for you. Do you think it could work in Michigan?
Okay, so I guess I do have a little anecdotal evidence. I love coffee. I've never been to Dutch Bros, but I drink a couple cups of coffee every single day. And at my campus in undergrad, there was this, like it was on a corner of two really busy streets. And it was just this little tiny 100-foot shack, square foot shack that just sold coffee. And that was it. It was called Bear Claw. And just, it sounds like Dutch Bros. Their entire property was dedicated to people in line waiting to service them. They were always busy, great coffee. Hopefully this gives them some new business. I loved them. They were really nice. But that kind of reminds me a little bit, without the cool culture and the culty aspect of it, that reminds me of the business model, a little bit of Dutch Bros, and it worked really, really well. So very anecdotal evidence there.
All right, Ryan.
Yeah. So I'm not necessarily a recurring customer now, just because I don't really go out and buy that much coffee. But in college, there is one kind of near my college town, and I've been there several times. It is to kind of give an experience. You like to illustrate what it's like. You basically drive up, you pull into one of those 5 lanes. It's usually quite congested. And it's usually on a busy corner. So it's a little stressful in that regard. But then you have what they call a runner come up to your car. And this has become sort of a funny thing on TikTok of people. They're almost like invasive of personal space. They like lean into the car and like ask you how you're doing. It's a little weird, but you take your order there, you go through, and then at the shop, they're basically just blasting music. And that's the whole like make it a celebration thing.
They're trying to get it energetic.
It does. Yeah, they do a good job. It does feel very fun when you go. People tend to love it, and
feels like Chick-fil-A a bit.
Yeah. And I mean, they give away like a lot of free stuff. They have their loyalty rewards program, which I think is like 1 free drink every 10 drinks. And that's been shifted over to the app. They give away the puppuccinos for your dog. There's stickers. We've got some on our fridge over here in the office. People love the stickers.
They did compare their Dutch Bros brand, like I bet we have it on our fridge here. In the S1, they compared it to nurturing the Nike swoosh. That's ambitious.
Wow.
But I think they got a long way to go there. But again, that is, that's a good goal to have. They compared to that. I was like, guys, you may, maybe something smaller. I don't know right now, but that's what they're trying to build though. Some similar to that sort of brand. I have never been. The only thing I thought was kind of funny is the S1 was their culture. They don't miss on what they're gonna be like. Why, like Ryan said, the S1 was yelling at me a bit. I was like reading it. I was like, stop. I don't know. That doesn't really matter. But the one thing I want to talk about though is this kind of like one, the Broista name is funny. It's a good name. It sticks with the brand. But on a serious note, as an investor, do you think that, and Ryan, you talked about it, the fun-loving stuff, the coming into your car and trying to talk you up, get it all energized. Do you think in certain areas of the country that might not fly as well?
Well, we'll see, because they just expanded into Oklahoma, and they've seem to be doing well in Texas since they've kind of opened multiple stores there.
I just kind of think about the Northeast. I don't know. They come in the car and they're like, someone's like, who's this guy? Like,
I think if there's anywhere that it wouldn't work, the only reason I think it might not work in the Northeast is traffic congestion, especially in a city like New York or something like that.
New York City can't. Yeah,
but I just don't see how it would work in a city like that.
But more rural. Yeah,
I figure if it can work in the South, it's going to work in the North.
I think the South is way easier of a transition. I'm going to disagree with you. That is a lot more family friendly atmosphere.
I guess we'll see. It's not like they go scorched earth and just add a whole bunch of stores at once. They do test stores essentially.
And they do test stores on regions, right? They're kind of going on certain regions.
Yeah. And they kind of try to make it like dense geographically. So like multiple stores around the same area. I guess we'll see.
Yeah. I could be totally wrong. It's just something that popped up in my mind. I know Starbucks has had trouble in certain areas. So not everything can go to even just in different parts of the United States. But future growth opportunities, this one's probably going to be simple, but Brad, what do you got for us?
Yeah, extremely simple. So I'll try and get a tiny bit creative. They did not really mention international expansion. The word international and global didn't show up in the S1. So it really seems like they rightfully so see this opportunity as fruitful and in the early innings, and they're going to approach it in the United States. But China, they are more and more loving their coffee. That is a strong growth market for Starbucks at this point in time. The transition away from tea into coffee is a very real one there. So maybe a few years down the road, that could be a promising second market to dabble in. Now, there's a lot of macroeconomic and political issues to sort out before they can pull that off. But a couple companies, Nike and Starbucks, just to name a couple, have been able to pull it off. So that might be a really well-placed expansion project after they feel like they've established their presence in the United States.
Yeah, it sounds like it's obviously really hard to do, to go to the different culture. And you probably, as like an investor, you're like, nah, they're never going to be able to do that. But you would have said the same thing about Starbucks 15 years ago, and they're a lot more successful than people thought. So Dutch Bros doesn't look like they're going to do it now, but I wouldn't discount that, because for some reason, American brands have traveled internationally a lot better than people may have assumed.
Yeah, and I know that I took sort of the
only
growth opportunity because it's a very replicable model. So I chose new store expansion. So sorry to you guys, but I think it could work anywhere in the U.S. except maybe New York. My experience on the East Coast with Dunkin' Donuts and Starbucks there doesn't seem very different from the West Coast. It seems like a pretty similar culture. Management said they think they can get to 4,000 locations in the U.S. Right now, I think it was 471. The caveat with this is, okay, so here's a quote from their S1. They said, "We currently have a strong new shop pipeline with approximately 250 new sites identified, which is well in excess of our planned new company operated stores to be opened in 2022 and 2023. The issue is that they cannot expand store count really, really fast. And maybe that isn't necessarily an issue. Maybe that would be a problem.
Well, they can, they're choosing not to.
They are choosing not to. And because they're trying to keep everything within the Dutch Bros system, the employees that want to start one, or the broistas that want to start their own, have to go through basically the education or the Dutch Bros schooling of how to own and operate one, which I think they call like the leadership pathway program. And so it takes time to do that. And so they're not just letting franchisees come in and just add new ones. So even if they had a whole bunch of cash, there's limited store expansion. They have to go at it gradually. And obviously, as you get more broistas in the pathway program, you can start to grow faster. But it will take time for that store expansion. 4,000 locations in the US, I would assume, will take 10 years.
10 years, probably, yeah. And that is a bit confusing, because I wish they could tell us what their projections of store count will be in 2022 and 2023, because they say 250 new sites identified, but how many are you planning to open each year? That would be a very useful thing for investors in your huge S1. But I have some just simple. It's locking in core customers with the app. This will really help same store sales growth. They launched that very recently. I think it was in 2020, right, Ryan, or 2019?
Yeah, it was during COVID.
They had 2.3 million reward members in the first 5 months after launch, which is huge for their limited region. I mean, that's just a great number. It shows how much people love this company.
Yeah, for reference, I believe so. Starbucks has 15,000 stores in the US. And I think they had 19 million members at the end of 2020, which was, I want to say,
it was good. That's good too.
That is good.
Yeah.
And this is, I want to say, double the pace. You got 2.3 million members. So a tenth of the member base on a much smaller fraction of the store base.
Yeah. Hopefully they can leverage that asset to, get into other stuff. But highlights and lowlights. Brad, what did you like? What did you dislike about this company?
Yeah, love the makeup of the team. That contrast between having the president, the co-founder, around with the company 30 years later, and having that COO who climbed all the way up the ladder and stuck around despite not getting any equity, and the CEO, and then comparing that with the CEO and the CFO with just really relevant experience. Bring in new energy and life and blood to the company. Hopefully, it was just a very well balanced team. But the low light, this was the most complicated balance sheet and ownership structure that I've read in a very, very long time. So that could be absolutely fine and just the way it is. But I mean, the simpler, the better with those kind of things. And that was the furthest thing from simple. So
yeah, they could have been doing it for a reason. And obviously they did it for a reason. You're not going to choose for no reason. But my question always is why? And if you're not explaining that clearly to me, I get a bit worried. It could be nothing, but it also could be something.
Yeah.
All right, Ryan.
Highlight for me, the cult-like following, especially where I'm from, the loyalty app metrics. They showed a lot of resilience during the pandemic, and employees seem happy. The culture totally checks out. So all the sort of qualitative things that I look for, the qualitative characteristics, they all seem to check the box. Lowlights for me, yes, the reorganization transaction was overly complicated. And it actually threw off the market cap for like every major financial site I think a lot of them still have it wrong.
Yeah, Robinhood gets a lot of stuff wrong, but like Robinhood had it wrong. People are like, whoa, Dutch Bros at $1 billion market cap. Holy, like, oh, yeah. You know, like, wow, I'm going to buy that now. Like,
I mean, it was like a 6X difference.
Yeah.
Now I will say that I asked the IR team via an email, and they were very direct. They told me exactly how many shares outstanding they had, and they explained it in a very easy to understand manner. So nice to see that they're approachable on that part. They aren't overly liquid. They don't have they are using this basically they're using the whole IPO process, it seems like, to kind of just clean up their balance sheet. Maybe that isn't a huge problem, but I wish it would have been more clearly stated.
Yeah, definitely. Because I think, all right, you're diluting shareholders and you're going to have these equity incentive plans that you just started out. I would hope that you'd raised enough money where we're going to be comfortable and we're not going to be worried about further dilution. Because you think when you're raising $500 million, you're not. But like we explained before, the pro forma stuff might be a bit less than people are expecting. Highlights for me, I mean, I think everything checks out with the business operations. Unit economics are great for a restaurant. You know, I mean, contribution margin at 29% is great. Reinvestment runway is huge. And the brand is fantastic. I mean, those are the 3 checks you want. Boom, done. Lowlights, though, besides the one you guys mentioned, which I agree on, when I read the S1 and I loved everything I read, and then I get to the related party stuff and I see that the founder's nephew is the chief culture officer and that 2 other relatives are like a part of the executive team, that concerns me. I bet it's not a big issue, but when you combine that with having sole voting power under this one person, I have to trust that person with my money. And it's only this one person. It's not a democracy. And when I see that, I think, okay, maybe this person was qualified for the job, but I'll admit it's a yellow flag for me for sure.
Did you happen to see how much he's getting paid?
No, but I mean, either way.
Yeah. I mean, there are definitely, it's a very family oriented business. They're trying to, you can tell they're trying to keep
for sure. I mean, it might not matter. It's just
family.
Yeah.
That's pretty much all we have for highlights and lowlights.
Yeah. Bull case, Brad, what do you think can go right here going forward?
Yeah, I see Chipotle as kind of the bull case in the adjacency of drinks and coffee. So Chipotle started, I think, in Colorado and Denver. And they had a very strong West Coast presence and had absolutely no trouble expanding Eastern throughout the United States. If that kind of brand stickiness and loyalty is similar for Dutch Bros, then it really looks like they have a long runway for future expansion across a pretty darn large market.
Yeah, Ryan?
I mean, the bull case, I like the Chipotle analogy. The bull case is that the model works everywhere. Within that 10 years, they get to the 4,000 stores, and they've sort of become saturated, let's say, in the US. That would be a great problem to have. And they also made a lot of recent infrastructure investments they talked about, which was just sort of like corporate.
That's because they had a lot of material weaknesses.
Yeah. And hopefully that maybe that adds a few points, a few percentage points to company operating margins. But
wouldn't you think that's going to hurt it though, because of employee count?
The infrastructure investments? I'm talking about the tech stack, like getting it all on the same.
Okay. Well, I was
like
thinking
the
of
point of sale system.
I was thinking of accounting thing because one thing popped up to me in the S1 is they said a risk was that they had few people on staff that currently had knowledge of GAAP accounting. And I was like, all right, well, you're going to have to hire a lot of accountants that could impact margins.
Yeah. I think operating margins will probably cap out somewhere in the 20% range. That's just a feature of this kind of business. If that happens, so if all that stuff works out, I think you're looking at an okay investment, to be honest.
Yeah. I'll run through
it's nothing like, it's not going to be an insane investment, even if that rosy scenario works out.
Yes. Let me look at my bull case. I have a little numbers on kind of what Ryan's describing, and this is kind of my glass half full thing. If you get to 4,000 stores, if you're at 1.7 million average unit volume, which is just average store volume, which I think you could probably underwrite would rise, but I'm trying to be conservative here. Yeah, I mean, you could easily see that at 2.5 million. If you have that 29% contribution margin, like they usually have on their mature stores, that is $2 billion about in annual contribution profit. That seems pretty good. That's a lot. And it seems like they convert that pretty heavily into cash flow. So it wouldn't be too much lower on cash flow.
Operating cash flow, which hopefully will be free cash flow over.
Hopefully free cash flow is a little closer to that over time. But yeah, bear case, Brad.
Yeah. So bull case Chipotle, and then bear case In-N-Out Burger. So I love In-N-Out Burger. Whenever I go to the West Coast, always get it, but it never really found its way into my neck of the woods. So the bear case is, for whatever reason, that this culture is just, it really identifies with the Western United States, and it doesn't really identify with other parts of the country, which Brett and Ryan have already kind of touched on as a potential risk already.
Yeah, I agree. That's a concern for me. Yeah.
Bear case for me, they're not gonna, it doesn't work in certain parts of the country. Perhaps the decision that the founder made in 2008 to kind of keep everything within the Dutch Bro system, maybe that does maintain the culture, which is hopefully what they're looking for, but it limits how many new stores they can open in the next or in the close future. So if you think they're going to get to that 4,000 stores really quick, it might take longer than you think, which is obviously going to affect probably the returns, at least in the closer term. I don't know. I'll let you put some numbers on it, but listen, it's 20 times sales, probably 1,000 times free cash flow.
Yeah. Let's look at, remember that the market cap is about $7 billion, $7.3 billion when we're talking, if they get to 4,000 stores, if they get to $1.7 million in AUV, and that's sustainable, again, I'd say you could probably assume it's higher. And if they sustain a 29% contribution margin across the country, which again, I maybe would be worried about because, they might not be as popular in certain regions. If you get to that, that's $2 billion in annual contribution profit. What's your cash flow yield on the stock on your cost basis if you're buying it, if you get to that maturity, which is what, in 2030, 2035, and you're going to be diluted by probably 30% over that time period by looking at their S1. So what are we doing here? I mean, come on, and then it happens to IPOs though. They just shoot out, it happens. Stock goes crazy.
Yeah. The other, let's get to the more or less interested.
Brad, more or less interested.
I'm going to go with more interested, I think. And I'm going to preface this with the IPO did get a little bit crazy. So I'm going to probably be pretty patient, but I see this as kind of like another comparison is Yeti, just really, really cult-like following and people identify with it and it gains traction everywhere. And I think they have something here. I mean, 5 drive-through lanes, pretty hard to fathom for me not ever being there, but I'm going to go with more interested.
All right, Ryan.
100% more interested in the business. I actually really like the business. I think everything checks out, but this is not how you make money. As an investor, I have no way to underwrite this at 20 times sales.
Yeah. And I'm definitely less interested from the stock right now. I mean, I think, and obviously we could be wrong. They could go insane and we could look foolish and it just could be $100 billion business. But, yeah, I mean, I doubt that. I mean, it seems like you're coming up against a lot of base rates here.
I mean, if if you're paying 4 times 2030 contribution profit in a rosy assumption, yeah, you'll probably make money. But that's a really rosy assumption. That's 2030.
Yeah. A lot has to go right here. I'll say I like the business model or whatever you want to, like I said, the operations check out. I have concerns governance wise. I think some of us may disagree on that, but I have some concerns. I would just look at it and see whether I don't know. Management's important.
Also, it's an IPO.
Yeah.
Like, I haven't touched an IPO ever, and I don't plan on starting now.
Yeah, always wait 6 months, research what a lockup period is. All right, that's going to do it for Dutch Bros. Brad, what do we got 2 weeks from now?
Yeah, so I own Olo, and we are going with an Olo complement / substitute / frenemy toast, more of a small, medium business focus within the restaurant world. So I'm excited to dig into that one to see how it compares.
Getting into payments again should be fun. Another IPO. Will be a fun business. I'm assuming the valuation is probably aggressive, but will be fun either way. That's going to do it for this episode. Thank you all for listening. Remember, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I are general partners at Arch Capital. Arch Capital clients may hold securities discussed in this podcast. Thank you all for listening. We'll see you next time.